Hi, my name is Allan Madan. I'm a chartered accountant in the Mississauga and Toronto regions of Ontario, Canada. The topic of today's short video is it better to lease or buy a car for a business in Canada? It's really important that you watch this video if you're a business owner or an employee who needs a car for work because it's going to affect your bottom line on your tax return. So I phoned a local dealership here in Mississauga, Ontario, Canada, and I asked, how much is it to buy a Toyota Camry LE? The total cost, including freight and PDI, other fees, and HST, is $34,910 to buy a Toyota Camry LE. So step 1, calculate the cost of the car, including fees and HST. Step 2 in the buy analysis is to calculate the maximum amount of the cost of the car that you can depreciate for capital cost allowance purposes. By way of background, you can write off the cost of an automobile at a rate of 30% per year. This is known as capital cost allowance or tax depreciation and is a direct deduction on your personal tax return. The maximum amount that you can deduct when depreciating a vehicle is $30,000. So since the pre-tax amount of $30,894 is greater than $30,000, then the maximum amount available for depreciation is in fact $30,000. Step 3 in our buy analysis is to calculate the actual capital cost allowance that we will receive. In year 1, the capital cost allowance is calculated as the maximum amount of $30,000 multiplied by the depreciation rate available for cars of 30% times a half. The half only applies in the year of acquisition to prorate the amount of CCA that you would otherwise normally get. So in year 1, the depreciation or tax deductions are $4,500. In year 2, the depreciation is calculated as $30,000 minus the depreciation taken in the previous year of $4,500 multiplied by 30%. And that results in capital cost allowance or tax deduction of $7,650. In year 3, the depreciation is equal to $30,000 minus the depreciation taken in the 2 previous years multiplied by 30%, or $5,355 of CCA deductions. In year 4, the capital cost allowance is $3,749 that can be deducted on your personal tax return. So the total capital cost allowance, which is tax deductions on your return over the 4-year term, is $21,254. I've assumed that we're going to own the Toyota Camry LE for 4 years, but the analysis could extend further if you plan to own your vehicle for a longer period of time. Step number 4 is to calculate the tax savings that you're now going to realize from all of these great deductions. This is part of our buy analysis. So I've assumed that you have a personal tax rate of 40%. If your tax rate is different, please go to my website, and I've shown you the link in green, where it will allow you to find out your personal tax rate. The residual value of the car, when I phoned the dealership, is in fact $11,898. That means at the end of the 4 years, the car is worth close to $12,000. I've assumed that you're going to use the car for 70% business use or work use. You'll have to adjust your percentage accordingly. Step 4, continue. So you can see here that we have our total CCA deductions from the previous slides of $21,254. The interest rate that the dealer was offering us is 1.9% for financing the entire purchase price of about $34,000 over a 4-year term. So the interest cost is $1,371, and this is also deductible on your tax return. The subtotal of all available deductions is $22,625. When I multiply that by 70% business use, it is reduced to 15,838 of available deductions. Now, the actual money in your pocket or tax savings is calculated by multiplying the 15,838 of available deductions by 40% your tax rate. That gives you total tax savings of $6,335. As you can see, it's really important to do this analysis to figure out how much you're going to save in taxes. Now, let's calculate the cost of the car over the period of 4 years. Okay, in this step, I call it calculating the after-tax value of the car, and this is the last step in our buy analysis. So as you recall, the purchase price of the car, including all taxes and fees, is $34,910. Interest, $1,371, giving us a total cost of $36,281. If we sell the car after 4 years, we're going to get some money back. So that money back, or the sale price in the 4th year, will be $11,898, which is the residual value. I'm now subtracting my tax savings, which we calculated in the previous screen, for $6,335. That gives me the after-tax value of the car of $18,048. So basically, to buy the Toyota Camry LE, it's coming to $18,048 out of my pocket, or $4,512 per year. That's the final number we need for our buy analysis. What we're going to do now is calculate the lease amount and compare that to $4,512, which is the cost per year under the buy scenario, and see which is less expensive. So step 1 in calculating the cost of a lease is to calculate the total cost of the lease over the lease term. When I phoned the dealership, I was informed that the monthly lease payment, including taxes, is $516. The maximum deductible amount permitted by the CRA for lease payments per month is $800. Since the amount of $516, which is the monthly amount on the Toyota Camry LE lease, is less than the maximum amount of $800, the full amount will be deductible. The interest rate implicit in the lease per the dealer is 2.9%, so it's about 1% more expensive than the finance option. The lease is a 4-year term. So to calculate the total cost of the lease over the lease term, you need to multiply the monthly lease payment by the number of payments in the lease term, in this case 48 payments. The total cost over 4 years is $24,768. Step 2 is to calculate the tax savings from the lease payments. Now the lease payments, or the business use or work use of the lease payments, are tax deductible on your return. Hence you realize tax savings. The total lease payments over 4 years are $24,768, which we saw in the previous slide. The business use percentage is 70%. That's what I've assumed. So the deductible amount on your personal tax return over a 4-year term is $17,338. I assume the tax rate of 40%, which means that you would be saving $6,935 because of the deductions of the lease payments on your tax return, which is a significant amount. Step number 3 is to calculate the after-tax cost of the lease. The total lease payments are $24,768, those 48 payments over a 4-year term. The tax savings realized is $6,935, which we saw previously. So the after-tax cost of the lease over 4 years is $17,833, or $4,458 per year. The final step is to compare the cost per year for buying with the cost per year from leasing. The cost per year on an after-tax basis for buying the Toyota Camry LE is $4,512. This is greater than the cost of leasing, the after-tax cost of leasing of $4,458 per year. So in this situation, with these particular facts, it makes more sense to lease the car than buy it because it's less expensive. Now remember, each situation is different. So what I recommend is that you call your local dealer, find out the facts and figures relating to buying and leasing, just like I did, and then run the calculations. You can use this presentation as a basis for running your calculations. It may turn out that perhaps buying is better than leasing in your particular situation. It all depends on the figures. The other factors that you should take into consideration when buying or leasing an automobile for work or for business is the hidden costs of a lease. Once you return the leased car, often the lessor or the dealer will require that you perform some repairs, replace the tires, and give it to the dealer such that it's in a saleable condition. That is a hidden cost which we've not taken into account. The other hidden cost is that dealers often put a limit on the number of kilometers that you can drive on a lease. So if the limit is only 20,000 kilometers per year on a lease, but you end up driving 35,000, it may be way more costly to lease a car than it is to buy. Pride of ownership. I find that if you buy your car, you will have greater pride of ownership and probably take better care of it than you lease it. Cash flow is another factor to consider. It's less of a hit on the wallet to lease a car than it is to buy a car because the monthly payments are almost always lower on a lease than they are on a finance or outright purchase option. Finally, the interest rate implicit in the lease and the interest rate available on a finance option for a vehicle or car are very important to take into account. For example, if it's an 8% lease rate and to finance it, it's only 1%, then it's pretty obvious up front that it's better to buy and finance at 1% than lease at 8%. That wraps up my presentation on is it better to lease or buy a car for business or work purposes in Canada. If you found this video useful, I encourage you to visit my website, which is shown at the end of this video, http://madanca.com, or call me at 905-268-0150, and I'd be happy to speak to you. Thank you very much for watching.